Friends, I'm your host. In this episode, I will deliver the toughest, most eye-opening content that can help you protect your wallet. I believe everyone's heart has been bleeding watching the markets these past 2 days. On June 5th, U.S. Eastern Time, the global financial markets staged a sudden, indiscriminate massacre. The Nasdaq, dominated by tech stocks, fell 4.18% that day, the worst single day since the tariff crisis of April 2025. The chip sector was even more extreme, falling over 10.26% as a whole. Nvidia alone saw $328.3 billion in market cap evaporate in a single day. If it were just the stock market falling, you'd call it a correction. But what's strange is that a foundational consensus that has underpinned global financial markets for decades has collapsed. Gold fell 3.9%. Silver fell 8.04%. Bitcoin, the poster child for high-volatility risk assets, broke directly below the critical $60,000 level. Risk assets were crashing, and safe haven assets were collapsing right alongside them. Money didn't flee to gold, and it didn't stay in the stock market. Global capital seemed to receive some kind of retreat signal all at the same time. Many shallow macro analysts will tell you this happened because the U.S. non-farm payrolls data released that day was too strong and exceeded expectations. But today I want to use first principles thinking to show you the data is just the surface. The real eye of the storm is an unprecedented reshuffling and redistribution of global U.S. dollar liquidity. Today, I'll cut through all the market noise and connect the June 5th crash with several history-altering events coming this month: SpaceX's historic IPO, the new Fed chair's Wall Street debut, the Bank of Japan's aggressive rate hike, and even the rolling smoke in the Strait of Hormuz, into one single thread to show you the true hand held by Wall Street's top operators. Why did the same medicine become poison? Let's first dissect the most direct trigger of the crash. U.S. non-farm payrolls for May came in at 172,000, almost double market expectations, and the highest government job creation figure in 2 years over the past 3 months. Some people ask, companies are hiring aggressively, which means the economy is healthy. So, why did the stock market crash? This gets into a tricky economic thermometer logic. For the market, an economy that's too cold, say 35 degrees Celsius in human terms, means recession and stocks fall. An economy that's too hot, 39 degrees Celsius, means inflation can't be contained and the Fed has to hike rates, so stocks fall again. Only a steady 36.5 degrees Celsius of moderate growth feels comfortable to markets. The June 5th data was simply too hot. Even more unusual, back in January, the U.S. also posted a big upside surprise in non-farm payrolls, and U.S. stock futures cheered with broad gains. Why was the same beat good news in January, but a death sentence in June? The answer: the data didn't change, but where the market is standing changed. In January, the S&P had just finished correcting, valuations were reasonable, and the whole market was celebrating strong rate cut expectations. Good data was a reassuring signal that the economy had support. By June, the S&P had rallied for 9 straight weeks, surging all the way up. The long-term valuation metric for U.S. stocks, the cyclically adjusted price-to-earnings ratio, CAPE, stood at 40.88 as of June 1st. In the 155-year history of the U.S. stock market, this number has exceeded 40 only once before, at the peak of the dot-com bubble in 1999. Now, standing on the cliff of the second highest valuation in history, a blowout jobs report crashes down, inadvertently delivering the final blow that completely shattered rate cut hopes. The Fed won't just hold off on cuts. The probability of an additional rate hike before year-end has exceeded 50%. Long-term Treasury yields spiked instantly, pushing up the risk-free rate hard. Tech stocks and Bitcoin, leveraged at historical highs and dependent on a low-rate environment, were subjected to a ruthless, indiscriminate liquidation. What I described above is just the tip of the iceberg. The reason tech and chip stocks fell so hard on June 5th, feeling like a genuine stock market crash at 10% down, is that they collided with another far more lethal, deep-seated crisis. The tech giant's buyback flywheel has ground to a halt and is starting to reverse. Over the past few years, The reason US tech giants kept rising was a simple underlying logic: earn money, then massively buy back and cancel shares. With fewer shares in circulation, even without business expansion, earnings per share, EPS, kept pushing higher. But now, just the capital expenditure that Google, Amazon, Meta, and Microsoft are pouring into AI data centers and chips combined exceeds $725 billion this year. That figure is higher than the GDP of the vast majority of countries in the world. Let's look at the brutal reality for three of these giants. Google used to be a major buyback player. Last week, it abruptly did something that shocked the market. It issued $80 billion in new shares. Buybacks mean returning money to shareholders. Share issuance means asking shareholders for money.
Why?
Because it plans to spend nearly $190 billion building AI this year, and its existing cash flow simply isn't enough. Amazon's latest quarterly operating cash flow was $26 billion, but it burned through $44.2 billion in a single quarter just building data centers. The solution? Issue over $50 billion in debt. A year ago, it still had $26 billion in free cash flow on its books. Now only $1.2 billion remains, a 95% contraction. Meta spent $26.3 billion on buybacks last year, but after offsetting employee equity compensation, the float only shrank by 0.1%. Starting last quarter, Meta has already stopped buybacks altogether. The money-returning machines that once pumped blood into the market have collectively transformed into cash-devouring behemoths. What makes it worse? At this very moment, SpaceX, valued at $177 billion, is set to formally IPO on June 12th, draining $75 billion from the market. This is the largest IPO in human history. Google evaporates $80 billion, SpaceX issues $75 billion in new shares, and OpenAI and Anthropic are lined up behind waiting to raise money through their own IPOs. According to research estimates, the AI industry needs a continuous inflow of $500 billion per year, while the revenue the industry can realistically generate may cap at only $1.2 trillion. Accounting for various forms of financing, there is an $800 billion funding gap in the system. This is like a financial pipe. The technology and AI demand are real, but the pipe itself has limited capacity. When everyone is frantically pouring money in at the same time, against the backdrop of the Fed maintaining high rates and tightening liquidity, the financial pipeline, starved of supply, collapses first. This is the underlying asset logic behind the tech stock crash on June 5th. It vividly recalls the fiber optic bubble of the late 1990s. Telecom companies spent $500 billion laying fiber optic cables. Was the technology wrong? No. Today's cloud and streaming all depend on that fiber. But the investors who funded it were basically wiped out in a stampede of overcapacity and prices crashing 90%. The most famous example is Canada's Nortel Networks, which ultimately went bankrupt and was delisted. Whether the technology is right and whether investors can make money have always been two entirely separate questions. Sword number 1. New Fed Chair Kevin Walsh's first report card. Walsh only took over from Powell as the new Fed Chair on May 15th. The FOMC meeting is June 16th to 17th, his first public appearance since taking office. This new official is no pushover. He has clearly stated that the Fed cannot always be led by the nose by lagging economic data and should make decisions based on forward-looking judgment. Markets were counting on him to bring a more flexible combination, acknowledging ongoing challenges while using the interest rate tool more dynamically. In other words, rate cuts. But just 2 weeks before his test, on June 5th, the blowout non-farm payrolls report shackled his hands and feet. With ironclad evidence of rising inflation and full employment, Walsh is very likely to present an extremely hawkish posture at the mid-June meeting and cannot rule out signaling a restart of rate hikes. Sword number 2. The Bank of Japan's suicidal rate hike. Across the Pacific, Japan is right now on the razor's edge of its national financial lifeline. In an attempt to rescue the yen exchange rate, Japan's Ministry of Finance has poured in roughly $80 billion, approximately 12 trillion yen, through continuous interventions this year, and hasn't caused even a ripple. A few hours after each intervention, the exchange rate continues sliding toward the critical 160 level. Japan's foreign exchange reserves still sit at about $1.4 trillion, but $1.2 trillion of that is U.S. treasuries that cannot be touched, a protection fee that, if sold, would trigger the lethal fury of the United States. Setting aside reserves needed to maintain food and energy imports, the Japanese government is now completely at a dead end. Bank of Japan Governor Kazuo Ueda already signaled on June 3 that at the mid-June monetary policy meeting, even amid Middle East turmoil, a rate hike may be decided upon. But Japan's national debt-to-GDP ratio is close to 240%, the highest of any economy in the world. If it doesn't hike, the yen will fall like a waterfall and national wealth will be plundered. If it hikes aggressively, the fragile debt structure will be directly detonated, leading to national bankruptcy. This yen nuclear bomb, which could explode at any time, is putting global capital on edge. Sword number 3. The Strait of Hormuz and the U.S. debt dissolution grand plan. These past few days, Trump says negotiations with Iran are still ongoing on one hand, while the U.S. and Iran have already exchanged fire on the other, and the Strait of Hormuz remains in a state of blockade. To ordinary people, this looks like a geopolitical crisis. But to top operators like Treasury Secretary Bessent and the new Fed chair, this is a precisely choreographed macro grand plan. Use the crisis to attract safe haven capital, flood the world with liquidity, and quietly help the United States dissolve its debt burden, without anyone noticing. With Middle Eastern shipping lanes cut off, Japan and Europe, who depend on Middle Eastern energy, have no choice but to line up to buy U.S. crude oil at a premium. In May, U.S. crude exports set a historical record. When crisis hits, global safe haven money frantically pours into dollar assets, the dollar strengthens, and the Fed conveniently goes with the flow, continuing to shrink its balance sheet while absorbing the steady stream of global safe haven money to take on short-term U.S. treasuries, completing an optimization and transfer of U.S. debt in silence. Part 4. How should investors respond? Having seen this full hand of cards, do you still think the June 5th crash was just a random accident? I published 2 charts before Wednesday's open. One was the S&P 500 daily chart, which had already triggered a DeMark sequential 9 signal. Technically, the daily chart needed a correction. The weekly chart also showed 9 consecutive weekly candles from April through this week, also signaling a technical correction. Both daily and weekly charts were generating multiple confluences, a signal that a super large shakeout was coming. For ordinary investors, you must be careful not to be cannon fodder in this cycle. I had already told everyone on Wednesday, this correction would last at least 2 to 3 weeks, with the initial target around 7,400 points. Now, as of Friday, it has already broken below 7,400, faster than I estimated. Here are 3 concrete strategies. Strategy 1. Strictly control position size. Be wary of a second-stage collapse in high-valuation AI and tech stocks. Friday was the first collapse. The financial pipeline is too tight right now. Google is asking shareholders for money, Amazon is issuing debt, and internet giants have stopped buybacks. This major reversal of logic means the tech giant stock price flywheel is experiencing serious stalling. 3 strategies. Before June 12th, SpaceX's formal listing, and June 17th, the rate decision. Do not blindly go all in to buy the dip in tech stocks and chip sectors. Strategy 2. Rotate into short-duration, defensive assets. The S&P's CAPE ratio is at its second highest level in 155 years. Guarding against a valuation bubble collapsing back toward fundamentals is the top priority. Embrace short-duration, high-yield assets under managed inflation. The simultaneous decline in gold, silver, and Bitcoin on June 5th was a one-time, indiscriminate liquidity repricing event. Gold and Bitcoin have temporarily lost their traditional safe haven halos because funds are being redirected to short-term U.S. treasuries whose yields are rising on rate hike expectations. Money market funds and cash-equivalent assets lock in current high risk-free yields. Wait until the excess water in the pipe is drained dry. Then your cash on hand becomes the most precious ammunition. Strategy 3. Build a dynamic framework for tracking capital flows. Don't just watch single calendar events. The three indicators that will truly decide the life or death of your account are: 1. The direction of oil flows. Is oil flowing to Europe and Asia, or cementing the petrodollar and flowing back to the US? 2. The Fed's balance sheet reduction pace and Treasury absorption. Is global capital willingly flowing into the US to help absorb its debt? 3. The Bank of Japan's attitude at its policy meeting. Does it choose to detonate the debt or let the yen collapse? The World Cup kicks off on June 11th and will divert some global entertainment attention. But these three indicators above are what truly determine your account's fate. Part 5. Market Outlook for June and Trading Plan. On Wednesday that U.S. stocks would stage their final frenzy this week, followed by at least 2 to 3 weeks of correction with the initial target around 7,400 points. I warned before Friday's open that a significant decline was coming, and that day the market fell roughly 1,121 points. For next week, because Friday's drop was so large, with the index falling to around 7,340, if Monday continues down to around 7,340, this level could trigger a 1 to 2 day bounce. If that plays out, here's what you should do. The moment it bounces back near the 20-day moving average, immediately cut losses on the tech stocks you couldn't unload. Stop out there or set up protection, for example, by put options as a hedge. Between the June 11th World Cup opening and June 17th, the broader market will decline further. Especially after the Fed meeting results come out, there is a good chance the market reaches around 7,200 by month end. If the FOMC meeting delivers a rate hike expectation or hawkish language, the market could very likely move into the important support zone near 7,007. That would be the worst-case scenario for this month. If the FOMC statement comes out ambiguous, the market may bounce back up toward higher levels. So pay very close attention to June 17th. Bitcoin Outlook. From a technical chart perspective, next week Bitcoin is at an extremely strong support level. On Friday, it briefly broke below $60,000, but ultimately closed back above it. Given the current tightness in US dollar liquidity, further downside pressure cannot be ruled out. However, if you have no position at all, you can start slowly building a small position around $60,000. If you already have an existing position, I do not recommend adding to it now. Wait until the overall situation becomes clearer. The U.S. crypto bill is still being discussed in the Senate with no vote yet. Keep an eye on Senate progress this month. That said, the buying power at this support level is stronger than it was the last time Bitcoin was at $60,000. Most of the buyers here appear to be institutional. Defensive stock picks. Consider rotating into defensive consumer stocks next week. McDonald's is one I've mentioned several times. A medium to long-term position is ready to start. Starbucks is also worth considering. Cleaning/household product stocks, the most well-known defensive category, have started rising as of Friday. In addition, I am very optimistic about pork-related stocks due to inflation and African swine fever concerns. One particular pork stock I've been watching has broken out to new highs, even in this poor market environment, and has seen a large accumulation of call options recently. I think it could reach $28, $29 in 1 to 2 months. I don't have a position yet, but will look for a suitable entry next week. Another pork-related stock, PPC, has also broken out of a month-long consolidation platform and begun moving up. Once it pulls back to the 20-day moving average, around $29 to $29.20, that would be a good entry point. An egg-related stock that made headlines earlier this year during the U.S. egg shortage is also worth revisiting. It still has upside potential. Short positions. For those with short selling experience, you can continue building short positions on high-flying early-stage tech stocks, particularly small to mid-cap tech stocks with large cash flow exposure. Domestic Chinese clients received a notification on June 12th, next week, that outflows are restricted. So medium-sized Chinese-listed stocks can continue to be shorted. For example, PDD and XPeng, XPV. I currently hold short positions in these. Index inverse ETFs are also worth considering. For example, SLXS, I entered at $5.90, and it has already risen 31.54% in one day. I expect this to reach at least $10, though it will take time. If you found this content useful and it helps you catch the next golden wave, please like and share it with friends around you. Thank you for your attention.
See you next time.
I wish you all asset safety this month.